Thanks, everyone. Yeah, as you just mentioned, I just flew in from San Francisco, so I'm still a bit loopy. If I fall asleep halfway through, just please forgive me. But I'm Michael. I'm the CEO of Hummingbot, and this is actually the first time we're publicly talking about our new product. So I'm really glad to be invited by the folks at Melonport over here. Yeah, so first a bit about us. We started about a year and a half ago. I think what's unique about our team is that we have a pretty extensive background in both machine learning as well as kind of like blockchain engineering. So before Corn Alpha or Hummingbot, I had another machine learning startup. My co-founder was a quant trader. He was his day job was an Apple engineer, but he basically just traded Bitcoin with his machine learning models at night. And my third co-founder went through Consistent Academy. And before that, he was at Goldman Sachs. As I mentioned, we ran a quant hedge fund for about a year. The fund did okay. It beat Bitcoin handily, it beat Ethereum by a lot. But due to a number of issues, we decided to shut it down about a few months ago. And so a lot of what Hummingbot is really building off of the technical infrastructure we had built for that hedge fund. But because at heart, we're all engineers, we're a software startup, and we want to build software that everyone can use, not just us. I think what people don't realize, and I kind of realized this after spending a long time on Wall Street, is that financial markets are three-sided. And everyone knows about exchanges being the place where you go to trade, but there's a third actor that makes it all possible, which is a market maker. So I'm glad Charlie can explain a lot about this, so I can just move on and skip to slides which are more interesting. So this is what I think that market looks like in the crypto landscape today. So you have lots of traders, you have lots of exchanges. I think CoinMarketCap lists 234 by last count, and that doesn't include a lot of the DEXs out there. And what's interesting about the exchanges is that some are really large and others are really small. And that kind of makes sense if you think about it. It's like, the really large kind of global ones, like Coinbase and Binance are the largest. But then there's like all these country-specific ones. There's like ones that are, like focused on the Nigerian market, the Southeast Asian market. And then you have these decentralized exchanges which, trade tokens, but then a lot of them trade kind of all kinds of off-the-run assets, like CryptoKitties, like OpenSea, or like Ethereum gas futures, like on Veil. And so you have all these like tiny markets as well as large markets. But in my opinion, I think most of the market makers are only large. And that's because most market makers are algorithmic hedge funds. And as a market maker, you want to trade every market where your asset that you are trading exists, so you can capture all the information out there. And so what that kind of means is there's this really big technical requirement to actually being a market maker in today's market. And so if you look at folks like who are active today, like Jump Trading, Cumberland, and Circle, and Susquehanna, I mean, they basically all were quant hedge funds before that made the transition to doing crypto market making. So this is how it plays out. So I took this screenshot a couple days ago, and this is basically essentially the WETH DAI pair on Radar Relay against the ETH Tether pair on Binance. So pretty much the same trading pair, except one's DAI and one is Tether. But there's a significant difference in liquidity in these two markets. So bid-ask spread on Radar is 2.6% versus 0.4% on Binance, and the depth in the market is about looks like about 15 times higher on Binance than on Radar. And so, and this is, in my opinion, this is why DEX volume is so low, right? If you're a trader, even if you want to, even if you really believe in decentralization, if you believe in, kind of like you want the security guarantees and non-custodial nature of trading on a DEX, losing 2.6% every time you trade is simply not worth it. And I think unless liquidity improves, where bid-ask spreads are at least comparable to where they are on a centralized exchange, it simply doesn't make sense for a lot of users to trade on a decentralized exchange. And so, so we believe that if there were more market makers, then that liquidity would improve. Um, so. Oh, okay, so why aren't there more? How come these firms like Jump and Cumberland aren't trading on the DEX today? So we've identified 3 reasons. The first is technical risk. I've talked to a lot of market-making firms while doing research for this, and what's interesting is that a lot of them are very familiar with how centralized crypto exchanges work, in part because a lot of those systems have the exact same API frameworks as traditional stock exchanges and currency exchanges. But when I started explaining to them how, like probabilistic confirmations, gas, the risk of front running, if someone kind of like, buy a miner, or if someone pays more gas, these concepts are very foreign to most market makers because they come from the kind of like the financial world, not the crypto world. Again, regulatory risk. So we're a U.S. firm, and actually, so we because we need to know the counterparty of every person that we trade with if we are trading for our own account. It's actually really hard for us to be trading, even using our own product on a DEX, because we need to know who these people are, but however, individuals under U.S. law are classified as users, not exchangers, so they're not subject to the same kind of regulatory restrictions that firms are. And the third is inventory. So the tokens that trade on a DEX are much less liquid. As a market maker, that's your main risk. And therefore, it's like if you can trade kind of like a really liquid market, a really liquid token pairs like Bitcoin and Tether on Binance, why bother trading WETH and DAI on Radar? It's kind of like you're better allocating resources to the larger exchanges. So what Honeypot really is a way to introduce more market makers in the system. And so here's kind of like how it's architected. So we're inspired by how blockchain mining clients work, like Geth and Parity. So similarly, this is it's a client that you deploy locally on either your computer or in the cloud. And then the first thing we do is we add the ability for you to import or create an ETH wallet. And that is how we connect to all the decentralized exchanges out there. Next, we allow you to input your kind of API keys to different centralized exchanges, and that's how we connect to the centralized exchanges. And what we're trying to do here is take every kind of function that you would do on an exchange, posting orders, taking orders, canceling orders, maybe withdrawing and depositing, and making those functions exactly the same for every single exchange out there, regardless of whether they're decentralized or centralized. And what that allows us to do is abstract the exchange layer so that from the bot's perspective, you can basically run strategies across different exchanges, but call the same functions every time. And then on the other side, you have the strategies. So these are essentially Python plugins that you write, and they describe a certain strategy. And the strategies, so we've written a couple of them, but we want to support users in defining their own later on. So I think this kind of like, we believe, lowers the technical barrier a lot to market making. But I'm sure some of you are wondering, those of you who know how market making works, how can you actually let kind of like an individual be a market maker when there's a lot of fancy math and algorithms and all that stuff involved? And that's because initially we're focusing on strategies which are pretty simple, and I'll illustrate one today, and it's something we call cross-exchange market making. So the way that works is, if you recall from my previous slide where I compared the bid-ask spreads of Binance and Radar, so this is kind of like what the market kind of looked like. Radar's up top, you have a very wide order book. Binance is on the bottom, you have a very tight order book. So, so as a market maker, when you have a market like this is pretty typical. What you can do is you can make a market on Radar, the wider exchange, kind of like halfway, somewhere between where the Binance spread is, where the Binance levels are, and where the Radar levels are, right? So here, if the current market's at 96, 104, you make a market at 98, 102. Now, let's say someone comes and then fills your order. So what that means is here, someone's filled your buy offer, so that means you're selling. That is okay, so you're buying that asset for 98. So when that happens, the bot will go and automatically conduct an offsetting trade on Binance. And it takes the Binance out of the market. And so this is essentially the reverse of that. So when you bought that asset on Binance, now on Radar, you sell that asset at a higher price on Binance. And therefore, by doing so, you essentially lock in a small arbitrage profit. So this is actually a very simple strategy. I think everyone in this room hopefully should be able to understand it. But this is the basis of kind of like what cross-exchange market making is. And so what you're essentially doing is you're cloning the order book on Binance onto Radar and kind of adding a little bit of spread in between so that Radar benefits from the additional liquidity, but whenever orders are filled on Radar, the person running the bot also clips an arbitrage profit. So this is kind of like how the strategy works, and so we so we're basically like adding kind of these arbitrage type strategies like that, while also allowing users to define more complex strategies in the future. So we've been working on this really basically ever since we closed down our fund back in September. So we know the Xerox guys pretty well. So they gave us a dev grant in order to support their relayers first, and we're also working on something with them to allow kind of like any Xerox relayer to automatically get a Hummingbot connector as long as they conform to a standard API framework. So finally, let me show you a bit of what it looks like. So the alpha is a command line tool. So it's not nothing too fancy, but basically you run it in terminal. And so basically there's a pretty long kind of setup process where you kind of like, it runs a flight check. And so it asks you what exchanges you want to trade on, what token pairs you want to market make for. You plug in your Binance API keys, as well as your Ethereum wallet, and then finally you basically connect to a node that you send your signed transactions on the decentralized side. So after you do that, you basically just start the bot, and then it starts market making. I wish I could show you the screenshots of his market making, but we're still integrating that piece right now. But the alpha should be available in 2 weeks. It is a closed alpha, I should say, and we're going to launch it publicly around the end of March. Thank you.
Cool. Okay, I think we have at least one question, so we'll do that.
Yep.
Do you also handle the fee calculation for the script?
Yes.
Cool.
Great question. Yeah. So it's basically open source. So we're using a source available license, which basically means it's open source, except that if you wanted to just host our bot and then sell a hosted version of it to someone, then it prevents you from doing that. Okay. Well, thank you, everyone.